Hello everybody and welcome to our nonprofit auditor points, which is NAP, and I'm Irina Ryshkova, your nonprofit auditor. I designed these NAPs to help nonprofits to understand accounting standards better, and we are continuing our series on revenue recognition for nonprofits. So if you want to see beginning of the series, please go back a couple NAPs back to review them. And in the last episode, we talked about what qualifies promise, because we indicated that under revenue recognition 958, and for the contributions, we recognize revenue when they unconditionally promise. Those are very important two keywords. And we talked about what constitutes the promise and the difference between intent and promise. In this NAP today, I want to focus on the next word, conditional. Again, contribution recognized as revenue when it's unconditionally promised. Promise we discussed last time. Today we're going to discuss what unconditional means and what constitutes a condition. So not every promise is unconditional. Some promises really conditional. So when nonprofit receive a letter which looks like grants, promise, again we saying we need to look at substance to identify is there potential condition involved. And this is one of the most common area where the nonprofits get revenue recognition wrong, because it's a lot of reading and analysis involved to understand if there is condition in place or it's really unconditional. So let's answer the question, what makes contribution conditional? Under general accepted accounting principle, condition is when we have both present in agreement. Number one, barrier. There's some barrier that nonprofits needs to overcome. It's like a hurdle, meaning nonprofit needs to do something or something needs to happen in order to jump over that barrier. And the second, it's a right of return funds, meaning that nonprofit will not be entitled to these funds if the barrier is not met. So both elements needs to exist. In my practice, very often we see grants where we see right of return funds, saying that if something happened, you might need to return us funds. That's only one part. That might not constitute a condition. Only if they both present, barrier plus right of return the funds. So what is the barrier? I will tell you that mostly important, if you want to recognize barrier on agreement, the key word, it needs to be specific and objectively measurable. Any barrier needs to be very specific and objectively measurable. For example, agreement might state that nonprofits needs to attend specific event or meeting specific performance target. If agreement indicates target or measurable something, achievement, very vague and just overall statement of improvement, or just to say overall we want streets of the Oakland to be cleaner, it's not measurable. I want us to be more satisfied, it's not measurable, not specific. But if we will say that we want to make sure that you provide $200 or 200 meals to homeless people a week, that's very specific and measurable. Time, week, 200 meals, very measurable, specific. So only specific and performances and measurable objectively can create barriers. Like it could be also raising matching funds. Not just any matching funds, it needs to be saying, we want to give you $100,000. You need to match our donation with another $100,000. Specific milestones, they need to be specific, meaning we need to prepare the plan for the training, step number 1. Number 2, conduct 2 trainings per week in the months of April, May, and June. Then step number 3, to do a summer camp based on these programs where we want 1,000 children to participate in. So it needs to be very specific, measurable performances, obligations. They will create barriers. But not because not every description that the donor puts in a letter creates barriers. For example, grant might say fund must be used for youth education. That's a restriction or just overall how you want to spend money, but this is not a barrier. It's simply saying a purpose of the grant. Very often in my practice, nonprofits confuse some administrative tasks as a barrier. Sometimes grant will say you need to provide 6 months reports to us, and this is simple administrative task. Administrative tasks do not create the barriers. And they even say sometimes, until you provide us that report, we will not send you the next $200,000. Again, it's not a barrier. It's just they identify how they're gonna pay you funds, but you have right to these funds. And administrative barriers, administrative tasks do not create barriers. A barrier is something that must be overcome before nonprofit earns the rights to these funds. So if the barrier was not met yet, so meaning nonprofit does not have rights to these funds, meaning no revenue recognition until the barrier is met. Okay, so that's the first part of the condition. We said barrier plus right of return the funds. So let's talk about right of return the funds or right of release. This means that if nonprofit fails to meet the barrier, a donor has the right to either require funds to be returned if the funds were prepaid, or be released from obligations to provide the remaining funds. If that's the right exists, then it creates a barrier. So then the grant becomes conditional, and we do not recognize revenue until the barrier condition is met. What is the key accounting rules here? Conditional contributions are not recognized as revenue until condition is substantially met. When it's met, you do recognize revenue. That means that nonprofit can receive a cash in advance but cannot recognize revenue yet. And if nonprofit receive money on a grant that it's conditional, nonprofits needs to record a liability account called refundable advances, meaning that if the barrier will not be met, this advance will need to be returned to the funder. But if the barrier will be met, as soon as the barrier is met, then the amount will be removed from refundable advances liability by debiting it, and the revenue will be credited. So we recognize revenue, and we're decreasing refundable advances. Let me give you a practical example. Suppose a foundation awards a nonprofit $500,000 grant to operate a job training program. An agreement says funds will be provided only if nonprofit trains 200 participants, and if that target is not met unused funds must be returned. That's clearly a barrier because it's very specific. It says 200 participants, specific type of training, which is very and it's specifically identified. If you do not meet that barrier, you need to return all unspent money. So therefore, it's conditional contribution. Even if nonprofit receive funds like a first installment in order to do the training, so the cash came in, nonprofit cannot recognize it as a revenue. They only recognize it as refundable advances, and then as soon as the 200 participants participate in the training, they recognize revenue and remove refundable advances and record revenue. Suppose the grant agreement says we are awarding to your nonprofit $500,000 to support your job training program over the next 2 years. There is no performance target. There is no specific how many participants needs to be trained, what they need to do over what period. This is not there is no requirement to return the funds if the outcome is not achieved. So most likely it's unconditional support. So in this case, it will be recognized the full amount right away. It is restricted for specific purpose, but there is no condition because there is no barriers and no right of return the funds. Even if the grant specifies how money should be used, that does not create condition. It just overall use it for training purposes. There is nonprofits sometimes confuse condition with restriction, and it's very critical to understand the difference. Restrictions only limit how you spend money, how you spend funds. Condition determined whether nonprofit is entitled to funds at all. So if there's conditions, nonprofits are not entitled. Revenue is not recorded, period. But once funds are recorded and they're unconditional, then they can be restricted for some purpose or time or unrestricted. So distinction is very critical. Restrictions affect classification of revenue, and condition affect overall understanding if revenue will be recorded or not. So restrictions do not affect revenue recognition. Conditions do affect revenue recognition. Now I talk directly to the board members and see why that's critical for board members to understand. Because recognizing conditional grants too early before nonprofit have rights to these funds can significantly distort financial result of nonprofit. Organization might show a large surplus because it's recorded revenue for conditional grant as unconditional. So it can create instability and confusion. From the audit perspective, conditional contributions of the area of significant attention. So auditors carefully review grants that might be interpreted as a conditional to make sure that they recorded in a proper period only after condition was substantially met. Auditors look very carefully if there's barriers, if the right of return, and when condition was substantially met. And sometimes auditors do not receive full communication, and nonprofits might have additional clarification about conditions and when they were met. Therefore, nonprofits need to retain that information that was communicated by donors, that if there's any barriers, any right of return, it's preserved and communicated to auditors. Again, every revenue recognition can only be properly assessed and analyzed by reviewing substance of the document. simply seeing email saying congratulations on the grant that was attached in a previous email, which we do not have the attachment, we cannot dive into understanding the letter. We cannot see substance of the award, and we cannot determine if it's exchange transaction or contribution. If it's a contribution, is it conditional or non-conditional? If it's restricted or non-restricted? Again, these questions can only be answered by fully analyzing the substance of the document. Conditions are always delay revenue recognition. Restrictions do not delay revenue recognition. They only reclassify revenue from restricted to unrestricted when restrictions is met. So hopefully that was useful, and I am looking forward to see you for next snap, where we continue diving in deeper in revenue recognition standards for nonprofits. Thank you so much for being here, and looking forward seeing you next time. Have a wonderful day.